good planning, senior accountant early, paying provisional tax, for example, if it's applicable, all those things, and this general tidiness, making sure you've got your chattels deductions, you're deducting for all the other expenses that are related to your income and earning process, means that when you get to that tax bill time, no one likes to pay tax, but like insurance, no one wants it. But it's also like insurance, it shouldn't be negotiable. You have to pay, so you've got to get organised.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got the captain of tax himself, Matthew Harris, here to talk about how to save money on your taxes in 2025.
We are back in your life. Ahoy, Captain Harris. How you doing?
Attention.
So we thought we'd make this one a bit of a quick, punchy one today because, everyone loves to know how to make money or save money. We're going to talk about how you're saving money on that tax bill in 2025. James, hit him with a question.
Yeah, Matt, I think a lot of things are outside of our control, right?
Yep.
How quickly rents move to, how quickly capital gains go up, what's happening with interest rates.
Regulatory risk.
Yeah, what's the government going to do? But one thing you can do is make sure you've got a really tidy house to pay as little tax as possible that is legal.
Look, I actually love the way that you put that because the Tax Act is such a way that it's kind of like a rule book. And we're all playing the game. And the game is definitely not to pay no tax because the world doesn't work like that. New Zealand has a pretty fair and balanced tax system to a point. And if you set out to try and avoid paying tax, well, you're just going to end up in trouble. And I know that because you used to work for the Land Revenue. And it ain't the kind of trouble you want.
Yeah.
But definitely there's always going to be opportunity for business people, for property investors to minimise the amount of tax they pay within the law.
Yep.
So how do we do that?
Yeah, so I think the first bit is tidiness, and you kind of hit in the first sentence. The tidier you have your records, the cleaner your transactions are in terms of being able to track them through, the paperwork that you have, the more chance that your accountant is going to be able to go through those and determine that it's deductible.
I think the other piece to that as well, Mike, is if you want to grow a portfolio and you're coming back for more lending in the future, having a tidy house is also really important.
Oh, and the two, like having your financials done on time and done correctly makes a huge difference to the banks, like when we're trying to do a lending application. But to Matt's point, having different accounts for things, making sure that you're keeping all of the transactions associated with this property and these accounts, that sort of stuff just helps everyone tons.
Oh, definitely. And things like provisional tax, if you're a business owner and you breach certain thresholds, you have to pay provisional tax, which is tax in advance. And it seems confusing, but it's actually really simple. But the times or the dates that you get your accounts done will make it possible for you to re-estimate that, for example, to pay it down, pay less. So that's really important. And we've all heard the stories, right, of the local pub owner who's trying to sell his business and he hasn't been doing his books, he's been cooking the books, and no one's going to buy it because there's no value in it. So having a clean set of books is actually far more important than people realize to get ahead in life.
Yeah, and there's always that trade-off between in the finance and the tax world of I can maybe run the maximum amount of costs I can through an entity or a business, but it minimizes that profit. You pay a bit less tax. That's great. When a bank looks at that, they go, well, hang on, there's no profit here. This is really high cost. And you go, oh, what I'm doing is this. And they're like, I don't know. This is your books.
Be cool, Mike. Be cool. Give me the money. Come on. I want to have my cake and I want to eat it too.
And you know what's worse is if the Land Revenue look at that and they go, okay, so he's not making any money, but he lives here.
That's a
and
third
does
Lamborghini.
this. It doesn't correlate.
Yeah. So last year we had a change in the tax system where people were able to, effectively shift debt again where it was kind of against investment properties off their owner occupied properties. And there were some tax advantages to that. Is that something people should still be looking out for in 2025?
Yeah, definitely. I think because we have had the reversal of interest limitation rules, so basically property investors weren't allowed to deduct interest. Now they are again. That definitely opens the door for what I call tax efficient restructures. And that's most commonly occurs when someone might be buying a new owner occupied house. They have an existing investment property, which they maybe had for several years. And so the value of it has gone well up as property investments do over time, and the debt has gone well down, which property investments do over time. We will look at that as a situation to definitely make the debt more tax efficient. And by that, what I mean is that if we end up with a new owner-occupied property, let's call it $1 million, and we have an investment property that we can load $500,000 of that million onto, it just means that they're paying the same amount of mortgages, but they are paying less tax overall because they get a deduction for the investment property.
Yeah. I just spoke to a client just before this podcast, and they had $1 million on their own home and a debt-free $1 million investment property. And if you go interest rate to say 6%, that's $60,000. You're talking like $20,000 a year in tax, right? And it not being set up in the right structure.
Yeah, definitely. And that's just, that's one small example. And that's a really good example of how just having the right structure can save you money.
Yeah. And I've got a warning here. If you think you heard some information, you're like, oh, I'll go do it myself, or I'll just go ask my local accountant, or I'll sort it all out. I had a customer come to me the other day looking for these tax efficiencies, who had set the transaction up incorrectly, hadn't done it right. And I was asked to do the lending on it, and I wouldn't do it. I was like, no, I'm not doing this because the outcome you want. And I checked with our accountants, and I was like, you're not doing this right. And they're like, but my accountant told me this. And I was like, well, then I'm not your mortgage broker.
One of those accountants where 1 + 1 is whatever the hell you want it to
Yeah, 1 + 1 plus my invoice.
Yeah, and that's the thing. Make sure you're getting really good I know everyone trusts their professionals, but make sure you're getting good advice on this, because that could potentially be a massive headache for them.
Yeah, definitely. And for the record, we give good advice on it.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
So look, another place, whilst we're talking about property, that is a property-related tax deduction, which is often overlooked, is chattels valuations.
What's a chattels valuation?
Yeah, so a chattels valuation is like a property valuation. It's actually done by the same kind of person, so a registered valuer. But instead of doing the property and the land and its surrounding kind of properties to get its value, they actually go inside the house and they look at the chattels. So a chattel is anything that's attached to the house that pretty much can be ripped out of the house without it falling down. Yeah. Carpets, blinds, dishwashers, anything like that is a chattel. They'll go through and they'll basically get a huge list, and they'll attach the depreciation rate to it. And then you can give that to your accountant. Depreciation on chattels is the only non-cash deduction that you can get now as a taxpayer.
And let's say someone got 2-beddy townhouse, central city, somewhere like that.
Yep.
What is that? What's an average amount do you think that those chattels might add up to?
Yeah, so the most of the reports are based on a kind of $5,500 to $6,000 tax outcome over the life of the chattel. So significant.
Yeah.
Worth doing. What else have we got, Matt? How else can we save some money?
Yeah. So I think structures is something that we should really touch on. So we see this quite a lot, especially with the way that it's gone over the years. With look-through companies are really good examples. In the old days, before ring fencing, you used to be able to claim losses on investment properties. So you'd set up the look-through company 99% to the highest earner. They might, earn $200,000, and then you set it 1% to the lower earner might earn $50,000. So that was all good. Then we had ring fencing, so you can no longer claim that. And then what happens is interest rates went down for a while, and also you've held the property for a long time, so the debt has reduced significantly. So suddenly you end up with a positive yield property, which is sending 99% of the income for tax purposes to the highest tax bracket. So they're paying 39%, for example.
Yeah.
And then we've got the lower income earner who might be paying 17.5%, and they're getting 1%. So that's a really good example where structure won't be working for you anymore. And we are starting to see that a little bit. It might be $2,000 or $3,000, but all day long, $2,000 or $3,000 in your pocket is better off than in the Inland Revenue's pocket.
Oh yeah, 100%.
So what we can do in that case, and it might also tie quite nicely with maybe they're buying a new house and we can do a restructure on investment property, is we will look to restructure that property and the debt out to maybe a new LTC set up the other way around, or some other structure that's more appropriate for a cash flow positive property, such as a trust.
Yeah.
So, in short, structures are hugely important. And when we look at structures, a lot of people come there and say, oh, Matt, why would I bother with an LTC anymore? You can't claim losses. First problem, mindset's not right. you're a business owner.
Yeah.
You shouldn't even be thinking about making losses. If you can avoid those, you should be avoiding those. But what about professionalism? What about separate legal entity? What about limited liability? Those are all things that business owners, prudent ones, should take account for. So don't discount structures.
It's not related to tax, but we're going to do an episode on property predictions next year at some point in the future. And I think that entities, look-through companies and trusts are going to be back in a huge way in 2025 and 2026 for people wanting to grow a portfolio. I'm not going to say it now because it has nothing to do with tax, but I promise you, my prediction is one of my massive predictions is everyone who is like, oh, there's no point in a trust anymore. There's no point. It's coming back in a real big way.
I think you're probably right.
There you go. Interest deductibility as well.
Yeah.
That's back to 100% next year.
So it's back, yeah. So, and I think this is a really good thing. When I look at deductibility of interest and the concepts for removing it, I think they were wrong. I think anyone who deploys capital to try and make it a gain for income purposes should be able to deduct. And I know there's this huge argument that we don't have a capital gains tax and how is it equitable, but it completely misses all the part about providing accommodation at a cheaper rate than the government, about supply and demand, and about financial literacy issues. And I think probably, if we're going to have a tax episode without mentioning capital gains tax, we got it wrong. It's likely coming in the next 5 to 10 years, and it's probably about time, but it does not exist now.
Yeah.
And we can't run a tax system that's meant to be horizontally and vertically equitable, so treating two people the same way and two people differently. If you've got one property investor, new build, who can deduct, and you've got one property investor in situ who can't, doesn't work. So for me, I think it was a really great idea to bring that back. And I think it comes back to, now that it's back, make sure your debt is optimized. If it's a James example where you've got $1 million on your own home and none on your investment property, that is not optimization. You are paying more tax than you have to, so you should come in and see us.
Yeah. And the big thing, right, is when interest rates are really high, it's just a bloodbath, right?
Yeah.
Like it's just not fun. We're not really thinking that much about our tax. We're just thinking, where am I going to get the money to pay the mortgage? As interest rates start to drop, and they've already dropped from say 7.5% to about 5.5% about 1 year fixed rate, that'll continue to come down over time. There will start to be some profits, right?
Yeah,
and if you don't have the right structure, and if you're not well organized, you're probably going to spend the money as you go. So it's going to become a bigger and bigger theme going into 2025.
Yeah, I definitely agree. And what happens when there's a loss? Everyone goes, oh, well, who cares? Again, the wrong thinking, because you've still made a loss. In tax, now the maximum tax you can pay on $1 of profit is 39 cents. But the maximum loss that you can have is $1.
Yeah.
And people just struggle with it for some reason. But so when it's a loss, people don't really care too much, or they don't think about it so much, except in the previous environment where it was a loss, but you also paid tax, which showed you how perverse the rules were.
Yeah.
But you're right, exactly right. Once it's a profit, suddenly everyone goes, oh, I don't know where the money is. And so some good planning, senior accountant early, paying provisional tax, for example, if it's applicable, all those things, and this general tidiness, making sure you've got your chattels deductions, you're deducting for all the other expenses that are related to your income and earning process, means that when you get to that tax bill time, no one likes to pay tax, but like insurance, no one wants it. But it's also like insurance, it shouldn't be negotiable. You have to pay, so you've got to get organized.
So if you are self-employed, have an investment property, have a property portfolio, are looking at growing a property portfolio, and on your list of 2025 goals is, I'm going to get the gym sorted, I'm going to enroll on day one. Make sure you put on that list, go see your accountant, come see us at Lighthouse, get your tax sorted for 2025. James, sign it off.
Awesome. All right. Well, Matt, thank you very much for all of those helpful tips. Thank you to you, because you are going to subscribe to the channel. You're going to give us a like. You're going to give us a review, because we're growing this thing. We're making a difference to the average Kiwi, and we'll catch you next time.
Cheers.